China's one-year loan prime rate was cut by 10 basis points on Monday from 3.55% to 3.45%, just shy of the 15 basis points expected. That's as data have been pointing to faltering growth momentum and problems in the country's property sector. Country Garden, once the country's biggest property developer, is now on the verge of default, while Evergrande filed last week for bankruptcy protection in a Manhattan court. Country Garden is also to be removed from Hong Kong's Hang Seng Index on September 4th after its shares plunged 70% this year only, and also as the company failed to meet bond coupon payments and issued a profit warning. Let's get more on this now with Fah Kim Beng in Kuala Lumpur. He's the founder and CEO of Strategic Pan Indo-Pacific Arena. Thank you for joining us today. Right, so why was only the one-year rate cut and not the 5 years rate, the peg for most mortgages there in China? What message is this sending to markets, in your opinion?
What China is trying to do basically is to get a stronger and better handle of its own economy. To a large extent, no one really knows what China is going through, perhaps even the political leadership itself, because it has an economy that is very formal in nature, but it also has an informal economy. So to the degree when the rates are reduced by only a small margin and only for a year and not for the full 5 years, that's basically the National Economic Council of China trying to test the water, so to speak, as to how effective the policy instrument is.
Right, and how worried are you about a potential sharp depreciation of the currency there in China? Some analysts are saying they're not expecting a collapse of the economy, but surely the country is really greatly disappointing economic expectations at this point.
Given the fact that China is often seen as the manufacturing hub of the world, then obviously everyone has to be worried with the devaluation of the renminbi or yuan. But then having said so, this is a China that has gone high-tech, and it doesn't really export things on the lower value chain anymore. So as and when the Chinese renminbi or yuan is actually depreciating, it doesn't really send a seismic shock throughout the world of manufacturing because it's not involved in so many forms of production as ever.
Right, Fah Kim Beng, thank you very much for your update. And now let's get to other top stories from around the world. Pharmaceutical compliance data firm Qualifies has raised $12 million in its latest funding round, valuing the startup at around $100 million. Investors include H14, an Italian family office linked to the late former Prime Minister Silvio Berlusconi. The company expects to double its revenue to $10 million this year as demand for cloud-based compliance data services rises. Singapore Telecommunications has reported a slump in profits in the first quarter of this year by almost 23%. The firm logged a net loss of more than $65 million in the 3 months to June. Singtel also recorded a 2.7% decline in its first quarter operating revenue to $2.5 billion on currency exchange headwinds. And Australia's Westpac Banking Corp posted a quarterly cash profit of $1.15 billion. Expenses were also up by 5%, driven by higher supply costs, but also staff wages. Shares in the bank fell 2.1%, trading at slightly over $13 on the back of the report. Australia's major banks have all flagged stiff competition in the mortgage space as interest rates rose 400 basis points since May last year, currently standing at 4.1%.